and distribution account. So what is a liquidation and distribution account? A liquidation and distribution account is basically like a financial report of a deceased person where we are now handling their estate, which is made up of like assets, liabilities, and in that we also have to account for tax with SARS in the form of estate duty. Once we've done that, then now we go and distribute to the heirs. So a person can die either testate with a will or intestate without a will. Those are the two types in which a person can die. So now we do that financial report. Either the person died intestate or testate, depending on the facts. Let me just go. So our first account in our liquidation and distribution account is the liquidation account, which is made up of assets. Our assets are divided into three. We've got immovables, which, as self-explanatory now, these are your land, your houses, your sectional title, a block of flats, basically anything on land, stationary that does not move, forms part of your immovable assets. And then we've got movable assets. Now, those are like your cars, your jewelry, your shares that are not sold. So basically anything that like your household contents, your furniture, we call that movable property. And then the third one, it's claims in favor of the estate. So now these are our policies, money that we collect from investments, maybe loans. Let's say you die and someone owed you. Now the executor must collect money from that person. It's a claim in favor of the estate. If this phrase confuses you, alternatively, you can record it as cash. They don't mind in the board exam. You can either call it cash or claim in favor of the estate, whichever sounds a lot better for you. We are following, right?
Yep.
All right.
The
So
document that you're working off of,
yes.
um,
I will send it to you. Would you like it to have
okay,
it?
cool. Yes,
Yes.
please.
Okay. So now, before in our liquidation account, we are guided basically by the principles of marital regimes. So if you are married in community of property, and you die, in your liquidation and distribution account, we have to account for both what you owned and what your spouses owned. So, marriage and community of property, we've got this 50-50 principle. But when we do a liquidation and distribution account in a deceased estate, we are accounting for 100%. So let's say it is said that the deceased owned a house worth 1.5 million and is married in community of property, what we're going to do in our liquidation and distribution account, we're going to include the full value of the house. So we are not going to say 1.5 million divided by 2 and then we account for that. No, we account for the whole estate.
Why?
Remember, we first have to account for everything that's in the estate because we're still going to have to take into account the liabilities and everything. And in your liabilities, still everything must be paid. So hence we account for everything.
So will you then take off the spouse's part at a later stage?
Yes, we're gonna take out the spouse's
Okay,
part at a later stage. That's in
okay.
the distribution account where we distribute now the estate as well as the estate duty addendum before we pay SARS. Because now the other spouse is still alive, they cannot incur tax. So we then have to take their part of the estate, which is where we now apply the 50%, but that comes like at a later stage.
Okay,
And
thank
then,
you.
all right. And then another principle is that let's say now the deceased owned something in equal share with like a brother, a sister, or girlfriend. Now this is it's not in terms of marriage or anything, but just let's say you own a house with your brother, which was bequeathed by your parents, and now they said, okay, we're giving Christy and Caroline a house. And both of you, the house is worth 2 million, and both of you own it. You have got 1 million, and she's got 1 million. So what we're gonna do now in the liquidation account, because you guys are not, it's not, guys are not married, in the liquidation account, in terms of you being brother, sister, or not just being governed by a marital regime, you're gonna account for your share. So let's say it says, Christy owned a farm to the value of 2 million with her brother. when we draft your liquidation account, we are not going to account for the 2 million, but your share, which is the 1 million. So
Makes sense.
so just take into account that. And then another principle is that in our liquidation and distribution account, the sold for price has got preference. So at all times, you're gonna get, let's say the facts say the deceased owned a house that was valued by the municipality at 1.1 million. The executor managed to sell the house for 1.5 million. In this instance, which price you're going to take? You're going to take the 1.5 million, which the executor managed to sell the house for. Because remember, when you sell the house, once the sale proceeds, you are going to collect the money, and the 1.5 is what is coming into the estate. Same goes for a fact that says the executor, the deceased had shares in the value of 100,000. The executor managed to sell the shares for 90,000. You are going to account for the 90,000 in your liquidation account. Why? Because the actual money that we are receiving is the 90,000. Yes, the shares were valued at 100, but unfortunately we sold them at a loss. Hence, we are accounting for the actual money that the estate is receiving. And then now it's a principle also that you do not account for profit or losses after date of death. So you will see in your facts, in your exam, in whatever, you will always have the date of the deceased when the person died. You will always take that thingy that look at me now. Okay, no. Okay, just hold on, guys. Okay, like for instance, here they say A and B were married to each other out of community of property without accrual. A died on 17 January 2024. So in terms of the liquidation and distribution account, in your liquidation account, you only account for profit or loss after date of death. Anything beyond that cannot go in. So let's say they give you facts like this. Sonia had an investment with paper capital in the amount of 600,000. She died on 27 January 2023. The executor collects interest in the amount of 50,000. 20,000 was at date of death. Now, how are you going to account for this? Because the capital that Sonia would have invested is 600,000. And of that 600,000, we gained profit in the amount of 50,000. Of this 50,000, 20,000 is what Sonia had when she died on the 27th of January 2023. So now we obviously are left with a 30,000. A 30,000 will not go in your liquidation account because it's after date of death. It will go into another account, which is an income and expenditure account. And this is an account that we'll get to later. Right now, we're still focusing on the liquidation account. Still, as I'm still explaining the principle, we'll put it into play. Just now, we're doing an example of a past paper. So those are the 5 principles that you cannot miss. If anything in the exam, you cannot miss these 3. If there's anything that you do not understand at this stage, maybe you can ask me before we go to the other principles.
I think I'm good for now. Thanks.
Okay, good for now. All right. So now those are the 5 principles, and then now we go into our movables, immovables. So immovables, as I explained, if you've got a farm, a house, a land, whatever, you will always use the sold for price if it was sold. If it was not sold, then you should only have one price, which is the valuation price. That's the price you are going to use. And then on movable, same. You always going to have, these are now things that are not sold, like your car, your jewelry, your household contents, your shares. What happens is that if it was sold, you are going to account for the sold for price. If it was not sold, you use the valued for price. It will always tell you valued at, then that price is what you are going to use for your liquidation account. And then we come now to the one that is a bit tricky. Claims in favor of the estate, also known as cash. Claims in favor of the estate, we're now talking your policies, your investment, loans that are collected on behalf of the deceased, savings account, and just anything means we are collecting money on behalf of the deceased. We put it under our cash and claims in favor of the estate. So now one example we have is our investment. As I explained that we do not account for anything that is beyond the date of death. So for our investment, we account for the interest up until the date of death. You'll always have a capital amount. Obviously, let's say you invest 50 Rand. That's a capital amount which you invested. And then at the end of your period, let's say we now collect 25 Rand in interest. The total amount that you have collected is 75. Of that 75, we say 5 Rand was up till date of death. So which means when the executor closed the account on your date of death, it was 55. So which means now we've got the 20 Rand on the side, which is after date of death. The principle is that 20 Rand will not form part of your liquidation account because it was after date of death. We put it in another account, which is the income and expenditure account. Same with the example that I made here is Sheila had an investment account with Z Bank in the amount of 80,000. The executor collected 110,000, including interest. The account had earned 10,000 in interest at date of death. And then now we're going to take the money that we collected minus, which is the 80,000 and the 90,000, because at date of death, the deceased's account was 90,000. Then whatever we get, the difference is interest after date of death, and we will not put it in our income, in our liquidation account. It will go to our income and expenditure account, a later account.
Is the income and expenditure account completely separate from the liquidation and distribution account?
Yes, it's completely separate from the liquidation account. So we've got a liquidation account, we've got let me just show you, it's 5 accounts. So we've got a liquidation account, a cash recapitulation statement, a distribution account, income and expenditure, fiduciary asset account, estate duty account, and executor certificate. But that's like a small certificate that you write to say that as an executor, you are aware of what's written in this account and you have accounted for everything that the deceased had. But the most important account that you cannot make a mistake in, it's your liquidation account, because the rest of the accounts, you're basically just taking amounts from the liquidation account and posting them as you go. So here, that's why your principles are very, very important. And then now we come to our policy. So it is a principle of your liquidation account that where a policy has a beneficiary, you do not include it. So the moment they say, Christy, let's say Christy is the deceased, Christy had a policy in the amount of, with, let's say, Old Mutual Insurance in the amount of 1 million Rand. Her spouse was nominated as the beneficiary. You do not include it. The moment you see beneficiary, you run away from it. And then where there is no nominated beneficiary, you include it. Where the beneficiary has predeceased, then you can also include it, because basically it means that the person died before the deceased person, so there isn't a beneficiary. A policy from an employer that paid out, you also do not include it. That's the principle. So your policies, remember, a policy that has a beneficiary, you run away from it. A policy by an employer, you run away from it. You only include where there is no beneficiary or where there is no where the beneficiary predeceased the deceased. So let's say it says Sheila had a life insurance policy with Old Mutual. Her father was the nominated beneficiary. Her father is predeceased. You are going to include it because my dad is predeceased, obviously. So which means there is no beneficiary because he is predeceased. So in that instance, you can add it. And then now another tricky one, it's in terms of marriage in community of property. You know that it's a principle that in marriage in community of property, you have to account for the entire estate. But when it comes to your policies, if it says the deceased nominated their spouse as a beneficiary, for the fact that there is a beneficiary, you stay away from that policy, regardless that it's marriage in community of property. I hope that is clear. Any questions?
Yep.
All right. And then now we also
Yes.
have another type of policy, which is a ceded policy. A ceded policy basically is a policy now where we say, I take a loan with Nedbank, and at the same time, I've got maybe a policy with Nedbank. And as a precondition for my loan to be granted, I then say, in the event of my death, when my Nedbank policy pays out, it will pay my loan that I have with Nedbank. So which means automatically when that policy pays out, it has to settle the debt that I have in terms of this loan. So that's what a ceded policy is. So with your ceded policy, regardless of the fact that this is a debt, because in our liquidation account, we do not record debts. We record debts in a separate heading, which is the liabilities. So in your liquidation account, you are going to record the amount that the policy paid out. You do not minus the loan amount or anything. You account for the whole policy amount that paid out. So you will see at a later stage, it will say the deceased A took a life insurance policy against the life of B. Oh, okay, no, this is another one. So yeah, so what basically it means is in your liquidation account under your claims in favor of the estate, when that policy pays out, you are gonna record it. You are not gonna minus the fact that, let's say they tell you that there was a loan against the policy in the amount of, you are not gonna minus, you're just gonna record the policy payout as it is. You'll see this as we go along. And then now it says policy taken by the deceased in the name of someone, e.g., blah, blah, blah. So we've got policies whereby the deceased, I take out a policy against the life of Christy, hoping that Christy dies first. Unfortunately, that does not happen. I die first. So now it tells you that the deceased, Sheila, took out a life insurance policy in the life of Christy. The maturity value was this amount, the surrender value was this amount. So a policy like that, how you treat it is, because I took out the policy, I was paying the premiums, hoping that when Christy dies, I cash out. And it does not happen like that. Unfortunately, I die first. What must happen to that policy is that policy must be surrendered back to my estate because no one is there to pay it anymore. I've incurred a cost, but the policy basically will not get to pay out. So it's a principle of insurance that if I take out a life insurance policy against someone's life, that person does not die, but I die first, we must surrender part of that policy into my estate. So now we are basically collecting money from the premiums that I've been paying on the life of Christy. So we take the surrender value because that account basically has to be surrendered. That policy has to be surrendered because there isn't anyone to pay the premiums anymore and there isn't anyone to benefit from it anymore because the person who was hoping to benefit has now predeceased that person. And then another one is, let's say it says Sheila took out a life insurance policy against her life. Are we still together?
Yes.
All right. No, I just saw a pop-up, so I thought maybe it disconnected something. And then another one is Sheila took out a life insurance policy against her own life. The maturity value was and the surrender value was. So now where there is a maturity value, I took it in my own life, there is no beneficiary, you are going to take the maturity value. The reason for that is that now, remember, I took it on my life, I died, obviously. So now the policy has matured. We are going to take the maturity value because the policy has matured, I died, regardless of the fact that there is no beneficiary, but we have to collect the money and bring it into the estate. So that's your principle. Okay, yeah, I've explained this. So let me just show you guys a practical example of now how we apply the principles that we have just learned. Okay. Okay, so now we've got, this can go. So now we've got our liquidation account. Which is made up of our assets, which is the immovable, your movable, and cash or claims in favor of the estate. So now you're going to have your item number and your R. Okay, so now here we are. It says A and B were married to each other out of community of property without accrual. A died on the 17th of January, just so that we remember. The 17th of January, he was survived by his major son. See, whatever, this does not matter. They just bring a whole lot of things to confuse you. So then it says a house 11211 Hill Street, Ladysmith, valued at. So now you see our house was valued at 3.5 million. Remember, our principle is that we account for a sold for price. If the house was not sold, we account for the valued price. So then you're gonna say 3.5 million. That's it. You've got your house, which is valued at 3.5 million. And then it says furniture and household effects valued at 700,000. Remember what we said? What are your furniture and household contents? It's your movable property, your movable assets. So now you're going to take, because it's a movable asset, it's not stationary or anything, you put it here. Household effects, 700,000. New shop. Okay, my love, we'll go to the new shop. Can I go to the new shop? And it's a triple coin with the oh, did you finish? Okay, my love, but can I teach and then I'll attend you. All right, sorry guys. And then it says a car valued at 260, which the executor sold for 300,000. Oh no, number 3. Okay, it says A 11,417 owing to Ladysmith municipality for rates. Remember, our principle says we do not account under our liquidation account, we do not account for liabilities. So debts, we don't account for it in our liquidation account. We'll attend to it at a later stage. So then when you see a debt, whether it's a mortgage bond, whether it's money that is owing on the car, you are going to leave that out. Another example would be, let's say they say a house at 1211 Hill Street, Ladysmith, valued at 3.5 million. There is a bond against the house in the amount of 500,000. You are going to account for this, the value of the house. The debt on the house, the mortgage bond, whatever, you are going to account for it at a later stage. In your liquidation account, you're just going to ignore that debt. You do not do anything with it. You do not minus or anything. You just leave it as it is. Now moving on to number 4. It says a car valued at 260, which the executor sold for 300,000. So somebody help me here. How do we record this one? Hello.
Could you please repeat the question?
It says a car valued at 260, which the executor sold for 300,000. How do we then record this one? Based on the principles that I've given you guys.
So if it wasn't sold, then you use the valued amount. So, and a car is a movable.
Yes, it's a movable.
So you'd add the car under movables and then add in the amount 300,000, not 260. It was because
Yes,
it was sold. Sorry,
yes. So
yes, it was sold.
yes, so you see, this is how you apply it. This is what
Yes.
the executor collected. Perfect. And then now, number five, it says an insurance policy with Sanlam on A's life. The surrender value was 66,680 and the maturity value was 1.6 million. B was the beneficiary. Now, what happens here?
So you're not going to add it because there's a beneficiary.
Perfect. You see, Christy, now you're fetching a distinction, girl.
Your imagine. Now,
You
please,
getting
please, I'm just trying to pass this.
you are getting that
Okay.
distinction. And then now
Oh.
number six says an insurance policy on B's life. The surrender value was 400,000. The maturity value was 950. A paid the premiums to the value of 186,000 on this policy. Remember, A is now our deceased person. What happens to number six?
Would you not? It's on B's life,
Yeah, it's on B's
but
life.
B, but B is
Yes,
still
B is
alive.
alive. Yes.
Please explain to me the surrender value again.
So a surrender value is, so let's say I take out a policy and I insure you. Our policy has, let's say I insure you for 1.5 million with the option of a surrender value for 500,000. However, unfortunately, I die first, but I had insured you. Remember, I was paying the premiums. So it's a law of
Yeah.
insurance that when you've got a life insurance policy on someone and you die first, that policy, what will happen is it will be surrendered back to the person who was paying the premiums estate. So I died first, so which means now the policy that I was paying on your life must be surrendered to my estate because I'm not there anymore to be the beneficiary or even pay the premiums.
Okay, so it's gonna go to A's estate,
Yes,
and which amount is gonna go to A's estate then? Is it
the
gonna be
surrender value.
the surrender
Yes,
value?
yes, it's gonna be the
Okay,
surrender value.
and what? Well, let me just make a note here. And what's gonna happen to the maturity?
The maturity value,
Oh,
we are not going to record it because it will never mature to A's estate. And the fact that the premiums are paid to their whatever value, that's also just another amount. They're trying to confuse you. Remember, obviously, in an insurance, there's like a waiting period. So that person paid what's his premiums to this amount, and they were now eligible to claim from that policy. So this is just basically the amount of premiums they paid. So now what you're gonna take is the surrender value because this policy must come back to Ace estate. Then the maturity
so the
value,
amount
you
of
just ignore it.
okay, so yeah, the maturity value is essentially the value that of which it would have been.
Yes, had um everything rolled out as A had
Yes.
hoped when he was insuring B. So
Okay, and
insurance
then
policy.
the amount of premiums that were paid doesn't have an effect.
No, it does not have an effect. You just ignore that.
So I see what they do. They try to confuse you.
Yes. No, most definitely. So that's why you must know your principles.
Let me just make a note.
Okay, and then now we move on. It says cash in the sum of 350,000 in a savings account at African Bank in B's name. So we always remember they are married out of community of property without the accrual. Our deceased person that we are preparing the liquidation account for is A. So now here they say cash in the sum of 350,000 in a savings account at African Bank in B's name. How would you treat this one?
I don't know, you tell me. Where's the other
You're gonna
friend?
leave.
Don't you want her to answer?
No, no, it's okay. So this
Okay.
one, you are gonna leave it out. Remember, when they are married in community of property, we do account, but they are not married in community of property. It's out of community of property without the accrual. So this is another tactic for the examiner to just confuse you. So always remember this as well, that if they're not married in community of property and the other spouse has, let's say, jewelry or an account with, it does not affect the deceased person's estate.
Okay, so every time if it's in the other spouse's name.
Yes, it does not affect
Okay.
unless they are married in community of property.
Okay.
Yes. And then, okay, this one this is a debt. We leave it out. Remember, it says the bond in favor of Absa Bank over the house, the balance as at 17 January was. So we leave it out. We are busy with our liquidation account. In our
Yes.
liquidation account, we do not account for debts. So we leave it out. G says
Yes.
SARS final assessment of 9,170. It's also a debt because the deceased owes SARS. We leave it out. It does not form part of our liquidation account.
No.
And then 10, it says attorney's fees for the transfer of the property and bond cancellation in the sum of. So obviously, when a deceased person has got a house, we are going to incur costs when now we have to report the estate at the deceased office so they can cancel the bond, transfer the property and everything. So that's also now, we have to appoint an attorney. That attorney is going to give us their invoice and say, you owe me this much. That's essentially a debt in the estate. We do not include it in the liquidation account as well because it's a debt. You appoint me as an attorney to transfer your property, to cancel your bond, and attend to all those things regarding your immovable property. I'm charging you. It's a debt against the estate. So you leave it out. It
Okay.
does not form part of your liquidation account. And then it says funeral
11 you would also then leave out.
yes, so but 11, they also like tricking you guys. So let's say they say funeral expenses in the amount of 36,000. Then you're gonna include it in your estate as a debt.
Why?
Because it says funeral expenses in the amount of, so which means it would have been the amount that we are incurring, but it's obviously still your your debt in the estate. However, the trick that you must be carefully if it's when it says funeral expenses in the amount of 36,000 which a family member paid. So when it says this, it's like me deciding upon myself and the goodness and my kindness of my heart to say that, no, let me pay for Christie's funeral expenses. The fact that
Um,
I paid has nothing to do with their estate.
yeah, it
Unless
has
I
nothing to do with
express,
my stuff.
yeah, unless it expressly states that um the family member wishes to claim from the estate. So if it's just like this, you are gonna skip it. It's not even gonna form part of your liabilities. It's like we accept it as a donation that okay, Christy paid for Sheila's funeral expenses and that's it.
If they say funeral expenses in the amount of 36,000 rand, dot, like end of
Yes,
sentence, full stop,
yes, you include
what
it.
would you then exclude it? Because
Okay,
then it
let me
doesn't specifically say which a family member paid, but is like once back from,
okay.
is gonna claim from the estate.
All right, let me just show you. So we've got three ways in which we are gonna get these facts. And then okay, once to claim from the estate. So option number one, you are gonna include it. Why? Because it basically tells us this is a cost incurred in the estate. So the estate incurred an expense of 36,000. And then this one, it says funeral expenses in the amount of 36,000, which a family member paid. So this affected the family member's financial position, but he did not ask to have that money paid back. So we do not include. We don't include because he does not want it back. It does not say he wants it back. And then here we are gonna include because he wants to claim his money back.
Why would you include an expense but exclude debt?
Okay. Let me just do this. Remember here, I'm not saying we included in our liquidation account. It's for a later account, which I'm just explaining how you treat funeral
Oh,
expenses.
so this expense, yeah, but I'm asking you just about the liquidation distribution account.
No, we don't include it. We don't include it at all. It's an
Okay, okay.
expense, it's a debt, yes. And then also now we move on. It says administration costs excluding master's fee and executor's fee in the sum of. This is an expense. We still don't include it in our liquidation account.
Yes.
Then 13, it says 100 shares in XYZ Pty Ltd valued at 80,000 and sold by the executor for 90,000. How would you treat this one?
Would it not be claims in favor of the estate,
Yes.
90,000 rand because it's the value that they sold it for?
Yes, definitely. So you're
And
gonna say
shares
shares.
is not movable or immovable. So it would
Yes.
be cash.
Then it is 90,000 because we made profit in of 10,000. We account for the money that the estate actually received. Now we go to 14. It says 150 shares in MTN Limited valued by the auditors at 10,000. How do we deal with this?
Same as the one above,
Yes,
150 shares in MTN and then 10,000.
150
Is
shares,
that like, is it 10,000 per share or 10,450 shares?
10,450 shares
Correct.
limited, which is now your 10,000. So then when you're done doing this, you would then calculate your total assets. So then you would calculate the total asset, which is from everything here, and you give the value of it there.
Okay.
Yes. So let's do another exercise.
Okay.
Yeah, you see how easy this is. Let me look
Yeah,
for
but you
another one.
make it easy.
It is very easy. Like paper two is the easiest, Christy. You are sitting there with everything. You just need to know the principles. Let me look for another paper, part two.
I have them on my laptop. Do you want me to send you some?
Okay, no, it's fine. Let me just find it here. Estates.
Okay.
Let's just find it. Yeah. All right, there's another paper. So you see how easy this is. If you can get 59, Christy, you don't even have to write the rest of the answers. You just write your liquidation account, stand up and leave.
Stand up and leave.
Yeah.
Imagine.
Because this is very
Yeah,
easy once
man.
you have the basics. Because this is the most important account.
Yeah.
Once if you mess up this account, your whole L&D is messed up. But if you master this, your whole L&D is gonna be correct because the rest of the accounts are very easy.
Yeah.
Okay, now we've got A and B were married in community of property to each other. A died on 13 March 2019. He is survived by his wife B, his major son, blah, blah, blah. All right. That's not important. And then it says A's house at 27 Dale Avenue, valued at 1.7 million. There is a bond over this property in favor of ABSA. The amount outstanding on 13 March 2019 was 570. When the executor settled the bond, the outstanding was 574,000. Okay, so now we've got our immovable property. Which amount do we account for?
Are we going to use the 1.7? Because even if it's a bond or whatever, it's like it's a date.
Yes.
It's not going to
Perfect.
affect the amount. So they're just adding that to make you dermakaar.
Yes, definitely. Oh, sorry, Nana. So you've got your 1.7 million. And then number 2, it says motor vehicle valued at 260.
Then you're going to add the motor vehicle under movable and you're going to add 260,000.
There you go. Motor vehicle, 260,000. Now we go to number 3. It says fixed deposit with Capitec Bank. The capital invested was 500. The executor collected a check for 517,000, which included interest of 11,000 up to 13 March 2019.
What was the date that the man died?
On the 13th of March.
On the 13th of March. So then you're going to use thereby cash and claims.
Yes.
You're going to add the fixed deposit. What do you call it? Fixed
Yes,
deposit.
Capitec Bank.
Are they
Then
fussy with how you name the stuff?
no, they're not. It just has to make sense. So you've got your capital
Okay.
amount. What is the capital amount that was invested?
500,000.
Perfect. And what was the interest that we earned up till date of death?
11,000. So you're going to leave out the 7,000.
Yes, perfect. Nana, I'm a little bit busy, ne? Okay. So then you see that it does not add up to our 517,000, but that's because the 6,000 was after date
After
of death.
6,000.
Yes. So in our liquidation account, we do not account for anything after date of death.
There, okay.
Yes.
Yes.
And then it says household contents valued at 160,000.
You're going to add it by movables and it's going to be 160.
Yes. Perfect. Sorry, guys, I was just fetching my charger. Yes, Nana.
In a window.
Okay.
Come on, let's see.
No, I'm a little bit busy, my love.
No.
No. Everyone wants to pass, so please let people
Shame.
be. And then it say, okay, we said household contents.
Yes.
Contents. Go call daddy. Go call your father. And make funny faces with him.
But she is making me sad.
No, tell daddy to stop making me sad. And then number 5 says, savings account in B's name with Star Bank in the sum of 16,780.
So these two people are married in community of property. So does that mean now you're going to add the 16,000?
Yes, definitely, because they are married in community property. Okay, let me just okay, what's not thinking of charging? I make this charge. So then we've got savings account goes under your claims in favor. Account, Star Bank.
Can I just quickly make a note of this?
Okay,
Yes,
16,780. Daddy is not fair. Call him again. You can't drop your call.
And if they were married out of community of property, what amount would you
We wouldn't include it
what would
at
you have
all.
done?
We wouldn't include it. Like you see, it says savings account in B's name with Star Bank, and they're married in Community of Property. But the previous one we did,
Of course.
remember, it said, where is it? But it was
Cash in the sum of 350 in savings account at African Bank in B's name.
yes. So we did not include it because
Number
they're not
7.
married in Community of Property. So these are the things. These accounts are always the same. You just need to identify in terms of the marital regime and which is which. Otherwise, what you see here, these entries are almost the same. So you just need to
Yeah, they're
practice
very
it.
similar.
Yeah. And then now number 6 says 66,000 due to Standard Bank credit card. A had an insurance policy with Standard Bank that settled the full outstanding amount. Remember what I said about ceded policy. It's like I've got a policy with Standard Bank in the amount of 66,000, and in that policy I also have a condition that when the policy pays out, it will settle my credit card debt. But now, what do you do with this insurance policy? How do you treat it?
You still add it. At a later stage, we're gonna
Remove it, yes.
remove
Christy,
it.
you should be an estate lawyer. I'm going to talk to Sunil
Oh,
tomorrow.
please, asseblief, don't do that to me. Imagine me as an estate lawyer. I'd probably tell the people they're already dead. What do you care?
Oh, sorry, it's Standard Bank insurance policy.
I know what you mean.
Now, this is very, very easy, guys. I always tell people paper
It
two is
is
the easiest
actually.
paper that you can find. And then SARS final assessment due by the deceased in the amount of 19,700. What happens to this?
Wait, just hold a minute. Sorry.
Yes, we just move on because at this point it's not relevant. And then insurance policy in Sanlam on A's life in the sum of 2 million with B as the nominated beneficiary.
Sorry, wait, I was gone. I'm back now. I did not hear a word that you just said. My husband was making funny noises outside, so I just told him to stop.
No,
We are
on number 8.
number 8.
Yes.
Wait, no. I still have to answer number 7. Such final assessment due by the deceased in the amount of 19,700. We're not gonna include it because it's a date.
Yes, definitely. And then it
The
says
insurance
insurance policy with Sanlam on A's life in the sum of 2 million with B as the denominated beneficiary. 2 seconds, I'm going to attend to my other human.
Okay.
Wipe your hands, we don't have wood. Okay. And then it says number 8, insurance policy with Sanlam on A's life in the sum of 2 million with B as the nominated beneficiary.
There is a nominated beneficiary, so we're not going to add it. We're going to run some baran.
Yes, definitely. And then we go to 9, insurance policy with Old Mutual on A's life. The maturity value was 850 and the surrender value was 410. There was no nominated beneficiary.
There's no beneficiary, so we're going to add it in under cash and closing save of the estate as an insurance policy with Old Mutual because it was
Yes.
on A's life, where the maturity value doesn't matter because it never matured to the full value. So we're going to add the surrender value.
Okay, wait, Old Mutual policy? No, just to correct you, remember it's on A's life. A's life is the one that we're preparing the liquidation and distribution account for. So which means he has died and the policy has matured.
Wait, the policy has matured, yeah.
Yes,
Um,
because he died. Okay, Mama, don't worry, the water will be back just now. And then we move on. It says shares in XYZ Pty Ltd valued at 86,000 and sold by the executor. Ouch, Nana. No. For 90,000. So which amount do we account for?
We're gonna add shares under cash and claims in favor of the state, and we're gonna use 90,000 because it was sold.
Yes, so shares and then 90,000. There you go.
So, and it's gonna be the same for number 11.
Yes, same for number 11. Shares, which is in 9,000. Okay, and then it says insurance policy with momentum on A's life in the amount of 1 million. A's son D paid the premiums and he was the beneficiary. The total amount of the premiums paid by D to Momentum plus 6% interest was 38,116. So what happens here?
He paid the premiums, but he was the beneficiary.
Yes. So his
The
son took
amount
out
of
a
premiums
policy.
that he paid doesn't matter.
Mhm.
We don't
So,
add.
so remember it says A's son paid the premiums and he was the beneficiary. So it's like someone else insuring you, and obviously when that policy pays out, it's not going to pay into your estate, it's going to pay to the person who insured you. So which essentially means that it has nothing to do with A's estate.
Yes.
Yes, so take it like David deciding to insure you, and when you die, he's gonna get the money. It's for his benefit. It has nothing to do with your estate. They're just giving you all these amounts so that you can sit and think and try to figure out something when there's really nothing to figure out. And then it says administration expenses, excluding master's fee and
Yes,
executor's
okay.
fee, which you must calculate amount to 30,000. Same. This is then
Wait. Administration expenses, including master's fee. It's expenses. We're not gonna add it.
yes. So we move on, and then it says funeral expenses were donated by A's brother. Don't do
It was a
anything here.
donation, so
Yes.
yeah,
We're not
it
gonna
doesn't have
include it.
anything to do with the estate.
Yes. And then proceeds of 367,000 from Samco Provident Fund.
Proceeds. I don't know.
Okay, so here
It's
Samco
something
is
that came in favor of the estate, so it should go there, but
remember our principle says we don't include policies that have a beneficiary, policies that are paid by employers. So this one, Samco Provident Fund, we know definitely that it is an employer, and for that reason, we are going to leave it out.
how are you gonna know it's employer?
They
How
will
do we
tell
know
you
it works for
it's
some?
either they will tell you that it's a provident fund, they will tell you that it's a UIF, or they will tell you that from the employer. So you know when you see
Okay, wait, so
provident
it's
fund, UIF,
UIF, um,
provident fund,
yeah.
pension fund, and employer. So once you see those words, you know that it's definitely from an employer. You're not going to include it.
Okay.
Yes. So basically, we are done for the night. So this is what we did the liquidation account. So tomorrow we are going to do we're going to do now the liabilities, which are very easy, as well as our cash recap. So if you do have time, you can maybe go to another past paper and read the facts, attempt it just the way I was doing it to see if your brain is still running. But really, this is it. This is just how easy this paper is.
I'm seeing the light at the end of the tunnel because let me tell you, after this weekend, like trying to go through this whole thing by myself, I was like, yo, I'm never gonna pass this thing in my life.
No,
Now
no,
I'm
this
feeling a
is
little
the
bit
easy.
better.
By the
Thank you
end
so
of the week,
much.
you will be mastering this account. Like I tell people, you can take max a week to master the liquidation and distribution account, its entirety. For you to get 59, it will take you a week. This is the easiest
Yeah.
thing ever.
Oh, I hope you're right. Thank you so much. Will you
No,
please
you have done well.
send me that other thing that
Document, all right.
you explained the principles on?
Okay, no problem. I will do that. And then, yeah, we're going to do for the whole
Mhm.
week so that we can just get paper 2 out of the way. And then next week we'll
Mm,
be starting with paper 1. So for the whole week, for an hour, we'll be attacking this account.
I'm completely happy with that. Thank you so much.
All right. No, you're welcome, Christy.
Have a good evening.
All right. You too. Bye. I'll send you just
Thank
shortly.
you. Thank you so much.
You're welcome. Bye.
Bye.